Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 15th of September 2019 and we're looking at the recent sell-off of bonds, an increase in government debt and the possibility of government refinancing over a 50 or even a 100-year term, and how these could affect precious metal prices. So let's investigate. Last Friday, there was a CNN headline entitled, quote, "Recession No More? Bond market sell-off pushes Treasury yields to 6-week high." We shall read you a little of that article, as it is well put together by its author, Sam Borgie. Quote, US government debt yields continued to rise on Friday, booking their biggest weekly gain in 3 years on better-than-expected data, China trade progress, and looser monetary policy. Government bond yields were higher across the board, extending a rally that began at the start of September. The benchmark 10-year Treasury note peaked at 1.91%, the highest since late July, according to CNBC data. The 10-year yield has gained over 40 basis points since the month began. The 2-year Treasury note jumped around 8 basis points on Friday to 1.81%. The yield on the 30-year bond added 11 basis points to 2.38%. Investors piled up government debt last month over concerns that the US and global economies were heading towards recession. The latest thawing in US-China trade tensions, combined with better-than-expected economic reports and looser monetary policy from the European Central Bank, have abated those fears for now. Like the ECB, the Federal Reserve is widely expected to cut interest rates next week. Fed fund future prices, courtesy of CME Group, imply a nearly 80% chance of a rate cut, following the September 17 to 18 Federal Open Market Committee meeting. Unquote. Now, back in August, the 16th to be precise, we produced a video entitled Inverted Yield Curve Explained, Stocks, Gold and Silver Price Ramifications. And we've put a link to that video in case you haven't watched or listened to it in the description box below. Now, in this video, we highlighted that if longer dated treasuries yielded lower rates than shorter dated treasuries or bonds, then the yield is regarded as inverted. And in the majority of cases, this has led to a recession within around 24 months. At the time, the 2-year Treasury yield was 1.634, while the 10-year was 1.623, a fair amount lower than it is today, which has now reverted back to their normal relationship. So this begs the question, of course, is a recession now likely, as the inverted yield curve normally suggests? Well, last Thursday, US government debt yields rose after core inflation exceeded analysts' estimates, signalling that the economy is performing better than previously feared. Now, this rise was not so large so as to spook markets, on the basis that the FOMC would desist in lowering rates this coming week, but was sufficient to suggest that the economy was not tanking either. Now, it's important to note that falling yields reflect higher prices for government bonds and lower appetite for risk-off assets. Equally, higher yields have the opposite effect. And to some extent, this is why we saw such a sell-off of treasuries this past week, in particular, as their prices began to fall. On Thursday, this environment propelled the Dow Jones Industrial Average towards its 7th consecutive gain. Now, in addition, Treasury Secretary Stephen Mnuchin said on Thursday that his department is, quote, seriously considering, unquote, issuing 50-year bonds as soon as next year, as it seeks cheaper ways to finance its massive debt load. He told CNBC's Squawk Box, quote, "This is something I've talked about over the last 2 years. It is something we are very seriously considering. We're looking at issuing a 50-year bond, what we could call an ultra-long bond. We think there is some demand for it. It is something we'll very seriously consider for next year," unquote. So, the recent sell-off in bonds has implications, and we shall attempt to cover them here. Please forgive us. We're going to express these in relatively simple terms so everyone can understand them regardless of one's knowledge of finance, but we fully appreciate it's a little more complicated than what we are expressing. There are 3 main categories of bonds: corporate, municipal, and sovereign debt, the latter being such as US Treasuries. For investors, a massive market sell-off can have significant implications. A sell-off in the bonds of one entity, such as, say, a public company, will have narrower consequences than one on sovereign debt. Now, we shall restrict ourselves to sovereign debt, or what many know as government treasuries. Now, the traditional logic runs like this and is expressed extremely well by Wayne Marks of Zacks.com. We'll quote him. "A large move by investors out of government-issued bonds is a sign that individuals, banks, and institutional investors have lost confidence in that government's ability to pay its debts. This happens most often when a country spends too much money and collects too little in taxes. Recessionary economic climates can exacerbate this situation and cause a government to devalue its currency or even default on its bonds. A devaluation of currency makes a country's bonds worth less money. If you own that country's bonds and suspect the country may choose that policy option, you will sell your bonds. So will everyone else, all with the goal of recouping at least some of the money invested in those bonds and moving it into the bonds of a more stable government, or into commodities like gold and silver, or simply into cash. If a country defaults, as opposed to devaluing, you will lose all or most of your investment," unquote. Now, this is the interpretation and quotation that our friends the pumpers use to help create panic, so that investors place their money in gold and silver, thereby creating fiat profits for themselves. They will argue the sell-off is the result of lack of confidence in America, the economy is going to tank, the economic environment will collapse, the dollar will shrink to zero. Get your gold and silver now. But there are other reasons why there can be such a sell-off, and one we shall put forward as perhaps what we regard as one of the main reasons. Thursday's auction tailed by 1.3 basis points, a sign that the bond sale struggled to draw in sufficient demand. The tail is the amount by which the highest yield the Treasury sold in the auction exceeds the highest yield expected when the auction began. So earlier in the day, bond yields rose on reports that the Trump administration was looking into a limited trade deal with China. So both the 10-year auction Thursday and 30-year auction on Friday were a little weak. More than half of the buyers were foreign, trying to escape negative yields and the need for foreign exchange reserves. Domestically, a small fraction of the treasuries offered were bought by the primary bidders for their own house accounts. In other words, it is domestic demand that is weak. This indicates that the trajectory of bond yields for the next month or so are likely to be higher. You see, when yields fall, those holding bonds see their capital price rise, and when yields rise, the capital value falls. So on the news that recessionary fears were abating, and that some of the geopolitical issues were also receding, Treasury yields began to rise. Now, of course, those who are holding on to significant capital gains, because until now yields have been falling, will want to materialize that gain. And so we saw a sharp fall off of buying and an increased rate of selling bonds. Where these monies went is currently uncertain, but we would argue partially into the equity markets, and perhaps many investors are still hanging on to cash. Now let's suppose we're wrong, just for a moment, and that the recent sell-off is because of concerns about the country's economic future, although other government data does not suggest this, however, but we are hypothesizing here. There is another trend which kicks into place, namely, that although sell-offs are dramatic to behold, they're generally short-lived declines, which stabilize or reverse themselves relatively quickly. Now, we saw this back in 2016, when an article penned in the Financial Times on the 6th of December by Adam Sampson, headed, "Rout shrinks universe of negative-yielding bonds by $2.5 trillion. And this is what it stated. The global stock of negative-yielding debt has tumbled more than $2.5 trillion since the summer, underscoring the dramatic sell-off in bond prices and easing the burden on pension funds that have been starved for income by low rates. The value of bonds outstanding with sub-zero yields has fallen to $10.79 trillion from $13.44 trillion in mid-August, according to TradeWeb data compiled for the Financial Times. More than 40% of the $2.65 trillion decline in negative-yielding bonds occurred in November alone. We'll add this, that's 1 month. Amid the worst rout for the fixed income market since at least 1990, as $1.7 trillion in market value was wiped from the broad Bloomberg Barclays Global Aggregate Index. It has been painful, no question, said Marilyn Cohen, president at Envision Capital, a fixed income manager, of the rout in bond prices that sent yields rising. Yields have risen across the board, led by the US, as investors anticipate substantial fiscal stimulus next year under President-elect Donald Trump. The abrupt rise in yields, while unsettling in the short term, represents the light at the end of the tunnel that we have been longing for, said Ms. Cohen, adding that the 30-year bond bull market that this summer knocked yields down to historic lows had become way overdone and made it difficult for clients, particularly senior citizens, who rely on the consistent income that bonds provide. Unquote. You see, many forget it was only a short time ago that we were technically in a worse situation than we are now in terms of negative yields. And yet, they corrected relatively quickly. And this has, to a large extent, been history repeating itself. Now, for those who believe that the US economy is over-borrowing to such an extent the economy is on the verge of collapse, had better think again. Many argue, how will the government finance its debts? It's impossible. Admittedly, last week, we saw new figures released by the Treasury Department showing that the federal budget deficit topping $1 trillion for the first 11 months of the fiscal year, and that it was the first time the budget gap reached that threshold in 7 years. Mainly the result of President Trump's tax cuts and spending increases, which have forced the United States to borrow increasing sums of money. But not only is Mnuchin, the Treasury Secretary, advocating 50-year bonds, as mentioned earlier, which will help delay the problems of repaying the debt, he will, if they are successful, also consider 100-year bonds. And before anyone says, oh, that's impossible, you may have to be reminded that there is history for this. You see, the United States used to issue debt with longer maturities decades ago, including a 50-year bond that was issued in 1911. The merits of returning to the practice remain a matter of debate, admittedly, among economists and investors alike. In the current environment of low interest rates, issuing longer-term debt could save taxpayers money in the long run by locking in reduced borrowing costs. The long bonds would also likely appeal to long-term investors such as pension funds and insurers, and they could be used to fund infrastructure projects. Now, we believe this is likely to occur, as back in August, President Trump publicly stated, quote, "I told Secretary Mnuchin that this is a great time to refinance our bonds, or some of our bonds," unquote. He then backed this up again last Wednesday, when he called on the Federal Reserve to cut interest rates and said on Twitter that, quote, "we should then start to refinance our debt," unquote. There's also precedence in that Britain, Canada, and Italy have sold 50-year bonds in recent years, and 100-year debt has been issued in countries like Mexico and Belgium. So what are we to glean from all of this? Should we be worried about a major bond sell-off? Well, the answer is yes and no. Yes, if the sell-off is due to a lack of confidence in the economy and the dollar. And the answer is no if it's simply profit-taking and reinvestment back into the economy by some other means. Now, we all know that an individual cannot go on borrowing increasing amounts each year indefinitely, and neither can governments. But when they are a world power, they can certainly devise new methods, systems, practices, and tools not to default, but to kick that can further down the road. If yields are beginning to rise, this will obviously have a negative impact on precious metals, and especially this coming week, though we are still expecting the Fed to reduce rates on Wednesday, albeit far less than perhaps the markets want. However, issues over Iran and the recent drone strikes on Saudi refineries will potentially have a different effect, a counter effect, potentially causing precious metal prices to rise. So we have to wait and see which of the two gains the greater prominence. What do you think? Do share your thoughts. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners. Glory, glory.